Hello everybody, I'm Roger. I hope you enjoyed my speeded up disclaimer. Today you're going to be looking at the Sortino ratio and a non-traditional way of using it, which is to help find a smooth equity curve with strategy testing. So this is the depth gauge strategy, which is taking long only in this setup, and it's governed by the filter at the bottom. So basically, when the blue line's above the red line, that's denoted as an uptrend, and it'll only take long trades. And while the red line is above the blue line, it won't take any long trades at all because it's deemed to be in a downtrend. If we look at the strategy performance report, this was on the time frame which was the most suitable for the settings employed. The Sortino ratio is 1.57, and the equity curve, it looks like this. Reasonably smooth, not too much problems. If we compare that to an equity curve, this one, which was a different time frame, you can see the equity curve is quite shocking. It's very spiky up and down, and the Sortino ratio is much lower. That was a 15-minute time frame with the same settings in the same date range. And there's an Excel sheet which I've prepared here, which has logged the results. I've been using a stop of 4.1 times at ATRs and a target of 5.25 ATRs, and logged all the time frames here. The Sortino ratio output here, the number of trades, and this little 1 and 0 column. Is the equity curve usable? Yes or no? So 0 means no and 1 means yes. And the best time frame of the settings was 6 minutes, which resulted in 796 trades and a 1 next to the equity curve, which I've just shown you. Now, what's really interesting here, everything that's got a 1 next to it has also got the Sortino ratio above 0.4. Everything with a 0 next to it, which means the equity curve was like the ugly example, which I showed you, which was this one, very, very low. These are all Sortino ratios under 0.4. Some are actually negative. And the key to this is that if you're a two-dimensional type of person that likes to look at numbers, rather than a three-dimensional person that likes to look at pictures, this is a very easy way to see which is going to have a nice equity curve. I've gone one step further and I've created another sheet here, which is focusing on the best 20 time frames. And what I've done, I've optimized these two values only, which has produced these as the best ones. And then I've used the same settings and run through the same time frames again. Now again, we have the ones next to the ones with a good Sortino ratios, meaning the equity curve looked quite good. And we had an odd one coming in where there wasn't one before. 17 actually came up. But what's nice is the fact that this peak is surrounded by roughly the same height peaks with a slightly faster time frame and a slower time frame. And this block of 3 is surrounded by another one which is lower and lower, roughly the same. This one is lower than that one, and this one is lower than this one. So we've got 3 and 3, making a more robust bell curve than was obvious in the first test. So this is still kind of a bell curve, but it's not validated by as many signals. So the settings here are substantially more robust over these periods. And if I just make these changes, get the right shot. That's the wrong shot. And I can show you that. Disable the strategy. Bring up the Excel sheet. 7.4 and 4.6. So the stop is wider and the target is smaller, which seems illogical. And it's not always right to have the target bigger than the stop distance, even though it seems counterintuitive. The loaded date range here is starting in on January the 1st, 2022. So now it's September the 20th, 2024. It's about 2 years and 9 and a bit months. So now if we look at the strategy performance report, you remember previously we had the Sortino ratio 1.57, and now we have was 1.8 just now. Something's changed, maybe a new trade, but it's higher. And if we look at the analysis, we can see the equity curve is somewhat better. So basically, when you do optimizations, if you use the Sortino ratio, you'll be optimizing for the best equity curve, roughly. Not always. Now, I've seen some where like 1.8 produces a slightly less appealing equity curve than one with a 2. But generally speaking, if you got numbers like 0.3, 0.2, the equity curve is not going to look very good. But if it's 0.6 or 0.8, the equity curve will look a lot better. So this is how we go about optimizing using the Sortino. We select optimization and then type the strategy you're using. And the parameters being tested are the long stop and the long target. Between 4 and 10, both of them, in steps of 0.2. If you choose little numbers like 0.01 or even 0.1, getting into the realms of curve fitting, and it's unlikely to be the best way to do it. It's much better to be approximate, even though, again, it's counterintuitive. Sikota once said, make your trading system fit like a mitten rather than a glove. Now, I'm not trying to catch every little twist and turn. I just want to make a system that's robust. So this is one of the reasons why auto increments are generally better, to get a better procedure. So everything else is left the same, standard settings. This is the instrument MES, the micro S&P 500, 6 minutes. 1st of the 1st, 2022. Break at end of day unticked. And also exit on session close is unticked. Got to standardize this. So if you always tick it, if you like to close out at the end of the day, make sure it's always ticked or your results will be wildly different. So Ninja Trader's got a lot of different metrics to use for optimization. We're using this one. And we're going to keep the best 20 results to have a look and press run. This shouldn't take that long. It's loading all the data into RAM and then it's running through everything. It will go green in a minute. Jack Schwager, who's the well-respected author of Market Wizards, he said the more something is optimized, the least likely it is to work in the future. And this is probably one of the biggest mistakes that people make. I've had customers buying very, very fast chips, PCs, loads of RAM, and they spend weeks doing all these optimizations and they think it's going to make their trading system better. And it's actually the reverse. It's more important to find a system that can operate on similar markets with similar settings. And if the time frame is adjusted slightly, it should still be giving good performance. And if the parameters are adjusted slightly, it should still give good performance. When it gets to being finely tuned with all the variables, you end up with something which is walking around on very, very thin ice, and it's very unlikely to keep working. I'll be back in just a moment while this is running. Just going to pause. Hello, everybody. I'm back. I've had a nice cup of tea. And more importantly, this has finished. Didn't take too long. So what we've got here is a very interesting demonstration of how these curves change. So the highest one, as I said, I already did it earlier, 7.4, you can see it comes in when you hover over. 7.4 for the long stop and 4.6 for the long target produced the best Sortino 1.8. Now, if you've got good eyes, that's what happens as I flick through these slightly. So this changed. You see this went all lumpy? Let's go back to that. Different height. You see it's lower. That bit was lower. Now this little number measures very carefully. These are all the same. And this one's 175. It's a very useful little number. Now before I forget, the date range is the same as it was on a chart, and all the simulations and testing standardized the date range, otherwise it's easy to get very odd results. During the course of doing this, I had this as 2024 by mistake, and these numbers were coming very high, much higher, over hundreds. And I said to myself, you know, Roger, you've done something wrong. So it was focused on this very little section. Sorry, not this section. It's focused on this very good section here, which was a lot better than some of the bits here. So it was a very spurious reading. And it's good that it happened because it's reminding me that the more data you do, the more robust the results will be. I don't mean go back to 1929 because the market was very different back then. Don't even mean go back as far as 1987, but go back as far as you can. You've got to try and go back as far as when the markets were similar. If you can do a year or 2 or 3, that's much better than doing a few months. A few months is better than nothing. But if you'd have tested this strategy from here to there, you'd say it was piece of junk. And if you tested it from here to there, you'd say it was good. So doing almost 3 years in testing is a good way to go. So as I'm clicking through these, going down to the lower ratings, Sortino ratios, and you can see the equity curve getting slightly worse as we head down. Sometimes it's quite difficult to see how it's worked it out. But as I said earlier, if you've got 1.8, 1.5, and then I want a 0.3, you haven't even got to bother looking at the 0.3 because the equity curve will be very ugly. So that's pretty much what I wanted to get across. I'll just move this out of the way. This is the depth gauge.